Okay, fun seekers, have we got a treat for you? Today, we are going to encapsulate the entire semester into one presentation. Do you want to eat well or do you want to sleep well? And we're going to learn why Mr. Warren Buffett, the famed investor, says investing is simple, but it ain't easy. So let's turn our attention to slide 35, investment return. And then we're going to discuss risk in great detail. Because it turns out that investment return is very easy. Over the long term, equities, stocks, corporations, businesses have produced the best returns. We have seen that they've done 8 to 12%, but remember, tell people 8, 9, 10% so you don't get their hopes up too high. Fixed income securities, bonds have returned 4, 5, 6, 7, 8%, but right now we're moderating people's expectations because bonds are paying very little. Don't worry, they'll go back up again someday when the economy improves. Please, pretty please. And then short-term investments, which used to return 3, 4, 5%, are now returning less than 1%. But again, that's going, it cycles, but it's going to go back up. Please, pretty please, which means the economy is getting better, yay. Mutual funds were more or less, often less, reflect the underlying assets that they invest in. So return is easy. What's the hard part? What's the ain't easy part? And that is the risk. So let's go to slide 36 and take a look at a dollar. Somebody put $1 away back in 1928. How did they do? They put it into stocks or bonds or treasury bills, which is a type of short-term investment we'll discuss in detail in our next presentation, or just let the thing sit in a bank at inflation or just sit in a mattress. And we see that stocks have clobbered the investment returns for bonds and treasury bills. So our dollar became $7,617 as of December 31st, 2021. Pretty darn good, huh? Whereas the bonds have returned, not bad, turned $1 into $91. But do you see the difference? That's what economists call opportunity cost. By putting our investment in something very safe like a bond, we excluded the opportunity of making more money through stocks. And then in short-term investments have beaten inflation, but not by much. A dollar in today was worth, $16 more than it was worth in 2028, or a dollar in 2028. Now it takes $16 to buy what you could buy back then. Of course, people were making a whole lot less than they were now. Now, again, investing is simple. You look at this chart and you say, oh, I want to invest in stocks, right? Well, here comes the ain't easy part. Because what's the problem here? They're using a logarithmic scale. We're using a logarithmic scale here. And really, you really shouldn't use logarithms when you're trying to display information to anybody other than scientists and the like, because people really don't understand logarithms. Look what's going on here. We go from, whoops, that was a mistake. Oops, sorry. My mouse is very, very sensitive. We go from $1 to $10 to $100 to $1,000 to $10,000. We're not going up by one linearly, arithmetically. No, we're going up by 10 to the first, second, third, fourth. We're going up by a factor of 10. That's a logarithmic scale. It's a non-linear scale, we say. And so this line that is what's happened to stocks looks fairly straight. Those little bumps Our ups and downs are big bumps. Here in what was it, 1998, we had over 1,000, maybe 1,200 or so, and then went down to 1,000. Actually, it was more than that, wasn't it? And so this is probably like 1,400, and you can't really see because it doesn't show the interspersing. But these little bumps are big bumps because of the logarithmic scale. That's the ain't easy part. And when the stocks fall, as they invariably will do, people panic. And that is the worst thing that can happen to you as a long-term, prudent-oriented investor, that you panic. That's the ain't easy part of investing. If we take a longer-term view, we see over 200 years that the news is good. Since the dawn of the industrial age, our standard of living, our economy has grown exponentially so that $1 in stocks is now worth over $28 million. Bonds have done pretty darn good at 42,000, but again, that's the opportunity cost, right? Would you rather have 28 million or 42,000? Well, if you can put up with the volatility, again, these little squiggles, because this is a logarithmic scale, these little squiggles are big drops. Treasury bills, as a form of short-term investments, have actually done pretty well compared to inflation. But look at gold. This is the one thing we want you to take a look at, because people hear about gold and, oh, we want to invest in gold because it's actually worth something. And it turns out over the long term, gold really isn't that great an investment. It's very speculative. You have to buy low and sell high. And we'll discuss it way at the end of the semester. But notice when gold does well, when people believe the world is going to end. Right? Civil War, 1860s, 1930s. And then gold started to levitate in the 1970s when inflation took hold and hit $800 an ounce in 1981. It then fell to $250 an ounce by 1999. So you see, there were 2 decades where your gold basically just continued to fall and fall and fall. And then it jumped up again when people thought the world was going to end after 9/11 and the like, only to fall again. So yeah, if we were only intellectual beings, you would show people this graph, stocks, bonds, short-term investments, inflation, and you'd quickly say, oh, stocks are the best choice. But we're not. We're emotional beings. And the fear of loss is great for many of us, especially after we put in $10,000 and it goes down to $6,000. No más, no más, necesito irme ahora. I got to get out of here right now. But that's the worst time, history tells us that's the worst time to bail out. And of course, if it does continue to go down and down and down until finally the whole thing has fallen apart, the whole economy has crashed, and there's no food at the supermarkets, there's no gas at the gas station, there's no clothes in the mall, there's no electricity being pumped out by the local utilities, the cell phones aren't working, the trash is being picked up, the sewers are backed up, the hospitals, the schools, the banks, the fire departments, and the police departments are all shuttered. Folks, your investments in your stocks and bonds and mutual funds are going to be the last thing on your mind. We'll all be digging for beetle grubs and boiling bark for dinner. But that's not going to happen. No, 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 no. Failure is not an option. As I've told you, the next 20, 30, 40 years are going to be the most prosperous years in the history of the world, assuming that we don't blow ourselves up, die in our own ways, tsunami, meteorite, disco returning. I'm very optimistic, and I'm old. And I'm old. We're going to cure cancer. It's happening. We're already having people with transplants of organs that were grown in a pig. DNA. I don't have to worry about the DNA is the same though as the individual, so you don't have to worry about the body rejecting it. We're going to have driverless cars. Maybe some of them will fly. We're going to have universal translators, such that you can go to any, well, most every, 5,000, 6,000 languages, not all of them, but many of the most important languages. You will just plug your little device in your ear. Maybe it'll be hooked up to your phone. Maybe it won't. And you'll be able to understand what that person is saying, and they will automatically be able to understand what you're saying. Very cool. I'm excited. I think, one of the best inventions coming down the pike for yours truly and those of us who are very old. I'm not sure if it's going to be a surgery or some kind of whatever, but we're not going to need our reading glasses that we lose every 5 minutes. I'm pretty excited about. So, do you want to be a part of it? Do you want to invest in the global economy? I hope so, because you're taking this class, and also because I believe that the next 30, 40 years, economically, financially, investment-wise, are going to be very prosperous. Now, don't ask me about the political. That's another issue, and that's a different class, so thank you very much. We don't have to go into that. But it does spill over into economics and finance and investments, though, sadly. Slide number 38. Look, folks, it is no accident that stocks and bonds have produced better returns than short-term investments, short-term cash investments that we'll deal with in our next presentation in detail. Otherwise, hey, why would you as an investor assume the higher risk of stocks and bonds? You wouldn't. If you could get the same kind of return from short-term investments, you would just assume what is called the risk-free rate of return. And notice it's in italics, so that means it's probably going to be on the exam. It's also one of the terms in the study guide, so I try to make it very straightforward, folks. The risk-free rate of return is the return on guaranteed short-term investments. And what they specifically usually use to quote the risk-free rate of return is the return on U.S. Treasury bills. Specifically, the 3-month is the number they will mostly use in the industry. But you could use savings accounts, you could use money markets. They're all very similar. It's the return you get on an investment that is guaranteed by either the government or the full faith and credit of an agency that has been blessed by the government. The risk premium is the reward for bearing the risk of an investment that is not risk-free. It's the extra return on a risky asset over that risk-free rate of return that we can quote on the internet or in news, whatever. And so here they are. Here are the average returns from 1928 to 2021 and the risk premiums that you received for investing in those. Now, obviously, there's no risk premium for investing in a treasury bill. That's why it's 0%. It is the risk-free rate of return. And they're not paying 3.33% these days, folks. You're going to see that in one of your assignments in the first chapter. But we should see that go up soon, right? Economy's improving, unemployment's really low, inflation's actually kicking in, so we should see this treasury bill return going up and other short-term investments, CDs and money markets and the like. But if we pick stocks, if we said, you know what, we're going to deal with the volatility, we got almost 12%. Remember we told people 8, 9, 10%? But it turns out that, as measured by a certain measure that we'll talk about later on, stocks have done almost 12%. Whoosh. Sometimes they've done a whole lot better. Sometimes they've done a whole lot worse. That's our next topic, the standard deviation, the variance. So we received 8.5% more than if we just invested with short-term investments. Long-term corporate bonds have returned over 7%. And our risk premium was almost 4%. And long-term treasury bonds have returned a little over 5%. They're paying a lot less now. And we've received almost 2% over the rate of the risk-free investment. Notice that inflation has, during this entire period, has run at 3%. Now it's running a little higher now, but before that it was running under 2%. since the global financial crisis. So we should, over the long stretch of time, expect it to revert back to the mean of about 3%, but we'll see how long it takes to get back there. But actually, it's a good sign. I know it's not fun to watch prices rise, but the fact that the economy is doing so well that prices are rising and people are getting better jobs and getting paid more, that's a good sign. It's another adjustment that we have to make, but it's actually a good sign. Now, can they handle this? We'll talk about this in our next presentation when we get to the Federal Reserve Bank. But the Fed has a lot of tools in their disposal, and we'll see what happens. We'll see what happens. I'm optimistic, but we'll see. Risk versus reward, risk versus return. The eternal struggle. Do you want to eat well or do you want to sleep well? Investment return is very straightforward. How much did you start with? How much did you end with? That's your return. How long did it take you to get there? But measuring how much risk you took to receive that return is much more difficult. In fact, it's pretty much impossible because we don't know what's going to happen next year. We don't know what's going to happen in the future. That's why they call it the future. Each year, the investment community measures the average annual return and the amount of variance from the average return. And using statistics, the resulting measures of risk are called variance and standard deviation. Now, folks, do not drop the class. This is not a statistics class. We don't do any of these calculations. We just go run to our little computer or our phone and look up these numbers because it's already done for us. So we will leave the calculations for your statistics class. Suffice to say that the higher the variance and standard deviation, the riskier the investment. The higher the variance and standard deviation, the more the investment return will deviate from the average annual return. What are you talking about, Payano? Look, we said that the average return over the last 80, 90 years has been almost 12% for stocks, 11.86, whatever it was. But that doesn't mean next year we're going to get 11.86%. We don't know what we're going to get. It might be 22%. It might be -5. It might be 3. It might be 17. You just don't know. And the higher the variance, the higher the standard deviation, that measurement, the more the return next year will vary from what the actual return is. Now, this math is first of all, we mathematicians do our best to make people confused by using symbols that don't mean anything. These are Greek numbers. This guy right here stands for sigma. It stands for summation. So what are we going to do? We're going to take the return in any one year from 1 to n, in this case, like 90 years. And then we're going to subtract it from the average return. That's what the bar stands for. And you put a bar over something, and that means average. Why don't they just say average? I don't know. It's math. Remember, my undergrad degree is mathematics. I always question them. So why can't we use words? Oh, you are not a real mathematician. I'd say you're right. So we take the return we received in any one year, subtract it from the average, and then square it. Now, why do you square it? You do that to get rid of the negative numbers. Because remember, some are going to be positive, some are going to be negative, and if you added them all together, they would zero themselves out. So you make the negative numbers positive. Okay, so now I keep everything positive. Then I divide it by n minus 1, the number of numbers, 80, whatever it is, 90, minus 1. Why do you take statistics? And so that gives us what's called the variance. They usually use this little puppy here with a square there. But the standard deviation is the square root. Because remember, we squared everything, so now we're going to take the square root when we're done. And they're just fancy terms, fancy smancy terms for you can lose a lot of money, folks, because we know that some years it's going to be negative. We just don't know which years, and we don't know how bad it's going to be. So we have to prepare ourselves emotionally. This is a distribution of the annual returns from 1926 to 2021. And this is sometimes called a histogram or a frequency chart. And what it's showing us is, hey, look, some years we got anywhere between 0 and 10, some years between 10 and 20, some years between 20 and 30, some years between 0 and negative 10%, negative 20%, negative 30, negative 40%. And you notice that it's skewed. It's pushed a little to the right of 10%. So in 2020, we got between 10 and 20%. In 2021, we got between 20 and 30%. Not bad. 2019 was a pretty good year. 2013 was a great year. 1958, 1954, 1933 and 35. Wasn't that the Great Depression? Yeah, come on over here. 1931, 1937, 1930. Yeah, the Great Depression. There's 2001, 2002, and there's the Great Recession, the global financial crisis. But what you start to see is a pattern that should look vaguely familiar. Does this look vaguely familiar? Familiar to you? Oops, wrong. I didn't mean to click, but I did. Vaguely familiar to you. It's called the normal curve, the normal distribution, the bell curve. In nature, nature's been very kind to us for some reason, and many distributions follow this normal curve, where there's a whole bunch around the average, and then you start to get farther away and it falls off. And so statistics has created the normal distribution. Now we've gotten about 11.9%, as we said, but in any one year, it's unlikely that you're going to get 11.9%. What we see is there's a variance. The standard deviation, plus or minus, is almost 20%. So in statistics, we find that in any given year, there's about a 2/3 chance that you're going to wind up plus 1 standard deviation or minus 1 standard deviation from the average. So out of 2 out of 3 years, you're going to be within 20% of that. It's a little over 19%, I forget the exact number. If you go out 2 standard deviations, it goes to 95%, meaning 1 in 20. 1 in 20 years, you're going to be somewhere between minus 27.7% and between 50%. And then when you go to 3 standard deviations, 1 in 99, it's actually a little greater than that, is going to be within 3 standard deviations. So someday you're going to get minus 40%, some year you're going to get minus 50, plus 50, 60%, but you just don't know when. So you have to be prepared emotionally for those years when the organic matter hits the ventilating device and your investment falls precipitously and you are feeling really, really bad. And you're ready to pack it in. Well, that's why Mr. Buffett says investing is simple, but it ain't easy. You have to be prepared for those. And history tells us those are the best times to invest. Mr. Buffett says, be fearful when others are greedy. When the market's raging, everybody wants to join in, right? Be greedy when others are fearful. When everybody's running out the exit, that's the time to buy. But who wants to buy when the price keeps falling? Our emotions take over. You with me? You understand? I hope so. And if not, stop. Right now, stop. Go back and read it over, watch it over, because it's very important. We know, unless the world ends, we're going to get a pretty darn good return from our stock investments, assuming we're prudent, long-term oriented, don't chase after the next big thing, invest in companies. We'll learn about the companies that have been around for decades and have returned good returns in good times and bad times. We know we're going to do better, unless the world ends, and then it doesn't matter. But living through those downturns is very painful. Let me tell you, it ain't fun to lose money. But we're going to do it. We're going to sometimes lose money, and we have to be prepared for that. And we're going to learn some techniques that help us live through those times. In fact, we're going to learn some techniques that help us prosper, take advantage of the volatility. How's that for a great thing to learn? Yeah, the news is good. So here's another view of risk versus return. Those large company stocks that gave us 11.82% gave us a standard deviation of almost 20%, over 19%, which means in any one year, we're going to be either 20% above 11.8% or 20% below. Notice, as soon as we move to bonds, that the deviation falls rapidly. Interesting, right? We get a lot less return, a whole lot less deviation. Do you want to eat well or do you want to sleep well? And then when we move to treasury bills, short-term securities, we see the standard deviation plummet to 3%. So we know that the change is going to be very low from 3%. Notice that inflation has actually been a little bit more volatile than treasury bills. Yeah, inflation's more unpredictable than short-term securities. So put this in your brain, burn it into the back of your eyelids. The greater the average annual return, the greater the standard deviation is going to be, and we don't have to do the calculations, it's done for us, and the riskier the investment. It's the eternal struggle between risk and return, and there's no way to get around it. If anybody tells you differently, yeah, don't listen to them because they're lying. And so now we can complete the global picture regarding risk versus return. Sure, Sweden had the best average annual return, but you had to accept almost 60% more risk to get that return. So the US at 15.6%, 24.9%, and notice Italy and Japan had a higher standard deviation and lower returns. What a bad deal that is. There is a reason, dear students. There's a reason why the United States economy, the United States stock market, the United States business world is the premier investing place around the world. Because investors know they're going to get a decent return and they're going to accept less volatility to get that return. Cool? I think so. Yeah, sometimes the phrase is sell ourselves short. We're here in the United States, and we sometimes don't think of ourselves the way the rest of the world looks at us. And some people don't really like us, and that's can't please everybody. But investors around the world, they like the United States, and with good reason. So, does you got it yet? You want highs return, you're going to get highs risk. You're going to lose some money. Maybe you're going to lose all your money, especially if you don't listen to Piano and invest in companies or speculate in companies that are selling pieces of the bright blue sky. If you invest in good long-term companies that have been around for decades and done well in good times and bad times, you're going to do okay. But if not, somebody gets you to invest in one of these fly-by-night corporations, you could lose all your money. And if anybody tells you differently, they're lying. So when, not if, but when, if you get involved in investing in any way, and you're already starting to get involved in investing, you're going to see advertisements for a 12% safe rate of return. Chances of losing your money are very great. This is scam territory. You're going to see claims of 300%, 3,000%, and you will. Don't. I'll show you some. Sit on your hands, grab your wallet, because these people are scam artists. Oh, by the way, they're also breaking the law. And you might say, well, wait a minute. Don't we have the freedom of press, freedom of expression, or freedom of speech? Yeah, in the marketplace of ideas, we got freedom of speech for the most part. Depending on how much money you have, how far your speech goes. But in the marketplace of investments, no. The investment community is highly regulated, and you have to be careful about what you say. You can't guarantee a 20% rate of return because it doesn't exist. It's a flying panda, a red unicorn. It doesn't happen, but you're going to see people try it. And there are people who have been doing it for years, and they get away with it. This guy Wade Cook did it for over 20 years, and Day Trading Coach, Online Trading Academy. There are dozens of them out there, and you'll see some examples in the in the website and in Canvas. So check them out. And so you say, well, why? How did they get away with it? It's illegal, right? But the Securities and Exchange Commission has a skeleton crew, and so they really can't police it that very much. What they do is they send a letter, stop that, stop doing what you're doing, and the people ignore it. And then they send them another letter. We told you to stop that. And then, eventually they come after them, and the people get up, leave, go somewhere else, and start a whole new thing. By the way, this happens in the supplements and medical world. There's lots of scam artists out there. There's a great, I got a link on the website and in Canvas to a presentation about supplements, weight loss supplements. They were putting all kinds of bizarre things in. So some of them were putting in Viagra and Prozac into the weight loss supplements. How they get away with that, I'll never know. But oh my goodness, I bet the people with Prozac were very happy they bought it. Huh? It made them feel really good. So you understand? If you want high risk, you're going to take, you want high returns, you're going to take high risk. And there's going to be times when you're going to lose money. And sometimes it's going to be a lot of money. And you have to be prepared for that emotionally. Because as Mr. Warren Buffett says, investing is simple, but it ain't easy. And that's the ain't easy part. And you might say, well, isn't somebody doing it? Well, yeah, it's true. Some people make tremendous rates of return. But those people are not investors. They are traders, Traders. They are speculators. And here is a quote from one of the first speculators from over a century ago, Jesse Livermore. The speculator is not an investor. His object is not to secure a steady return on his money at a good rate of interest, but to profit by either a rise or a fall in the price of whatever he may be speculating in. And so Mr. Livermore wrote a book about speculating and talked about how you really had to do your best to remove emotions from your thought processes. It's not easy. We're emotional beings. And there's a wonderful, wonderful interview. I got some of the materials from, because unfortunately Forbes took it down, but it was with John Bogle. And so you want to read that. It's on the website. It's in the book and in the Canvas. It talks about, are you an investor or are you a speculator? Look, being a speculator, being a trader can be very profitable, but it is incredibly stressful and very perilous. And you're up against the best in the world, folks. Can you throw a fastball at 98 miles an hour? Can you hit a fastball at 98 miles an hour? Not many of us can, but there are people who can do it. Can you sing a 4-act opera at the Met, at the Metropolitan Opera in New York? Not many of us can, but the people who can, they make a pretty good money. Maybe not as much as the baseball players. So you have to ask yourself, do you want to be an investor or do you want to be a speculator? We can help you learn how to become a prudent, patient, successful, long-term investor. We cannot help you learn how to become a successful short-term speculator. Sorry, it's something we can't do. We wish you a lot of success. We warn you that you probably won't last long. Most people don't. You think, maybe you thought when you came to this class that you're going to have 4 monitors and 3 computers and 4 telephones and making deals left and right. I don't think so. Investing should be simple. The ain't easy part, we're going to learn how to deal with, the emotions. But if you want to be a trader, I strongly recommend that you listen or pick up the book to the story of John Goodfriend versus John Merriweather, which was written by a gentleman by the name of Michael Lewis. Read every book he ever wrote. He's a phenomenal writer. Called Liar's Poker. This is the one he wrote that made him famous, Liar's Poker, but he also wrote some that were turned into movies like Moneyball and The Big Short. And he shows you just how good you got to be to go up against these people, because some of them are very, very good at what they do. And they'll take your money and they won't feel very sad at all, because that's their livelihood, that's their job. So please do listen to the story of John Goodfriend versus John Merriweather. I don't ever want to play Liar's Poker with John Merriweather. Okay, Payano, so you convinced me. Stay away from speculating. So what's a realistic rate of return for me? Well, after you've taken this course, you will have a strong knowledge of the most popular types of investments: stocks, bonds, cash, mutual funds. You will also know what levels of returns and what levels of risk you should reasonably expect to receive. And if you are a patient, long-term investor, I believe it is realistic to expect 8, 9, 10% from stocks. You may do even better. I'm certainly working on it myself. But of course, as we reiterate time and time again, we will reiterate it over and over again, there are no guarantees. Once you leave the short-term guaranteed investments, you're no longer guaranteed. But as we're going to see, as we've already seen, we're going to see again, the news is good. And turn off the television. Don't watch the nightly news, the nightly disaster. Read, and you'll live longer, believe it or not. You'll be happier too. At least that's what the sociologists tell us. Television doesn't make us happy. It's sad, but it's true. So, okay, all right, you convinced me. I'm not going to be a speculator. I'm going to accept 8, 9, 10%. But is that good enough? Slide 49. Is that good? Well, yes. It turns out the answer to this question is 9 or 10, 8 or 9% good enough. With some caveats. If you start early, if you are, and early we mean 30s, 20s and 30s, 40s, okay, but you don't have a whole lot of time. 50s and 60s, oh well, you should have taken this class 30 years ago. I get that question sometimes. Why didn't you teach me this 30 years ago? I say, oh, I'm sorry. If you're patient and consistent, because those are very important aspects, characteristics of prudent long-term investors. If you don't get cocky, too greedy, don't chase after every next big thing that comes along, like NFTs and cryptocurrencies. And most importantly, you don't panic when the market swoons, because it is inevitable. It will happen. We don't know when. People will sometimes ask me, is there going to be a crash? I say, oh yeah. They say, oh, what do we do? What do we do? I say, nothing. Because we don't know when the crash is going to be. We have to prepare ourselves emotionally, but we don't know what it's going to be. And we continue to invest even through the crash, which is the key to taking advantage of it. Later, folks, later. The trick is to take advantage of the time value of money. It turns out that if we have enough time, if we are prudent, long-term oriented, the news is good. Yeah. Now, we're not going to do these calculations. I hope you will at least go look at the results. Don't bother with the calculations. We're not going to do them. I'm not going to ask you to do them. We're going to do the reverse calculations later on. But I want you to look at least the answer key to show you that if you have a lot of time and invest prudently and wisely and get, say, 10%, you're going to do okay if the world doesn't end. Time value of money. The amount to which a sum you invest now will increase based on a specified rate of return and time period. Calculating amounts into the future is called compounding. That's the future value of money. We're going to do the present value later on. We can do it for a single lump sum single payment, single principal, lump sum principal. Or we can do it for a series of deposits, a stream of, I like this term of, think of a stream, like a river of investments. And of course, annuity, but I don't like using that term because annuity is also an insurance product and not a particularly good one. But that's what an annuity is, a stream of payments. We will also learn how to move from the future back to the present. That's called discounting the present value of money. Wait, later. When we learn how to assign valuations to stocks and bonds. So we're going to learn how to do these calculations, but not for several weeks. In the face-to-face class, we often would at least go over the answer key. So here, I hope you take a chance to go over the answer key and find out that if we have a long-term time frame, and even if we start with $50 a month or $100 a month, we should be able to do pretty darn well. And we're going to see these examples again in our second chapter when we look at mutual funds. So the news is good. But hope you'll take the time to at least look at the answer key and see the numbers and see what kind of wealth we can build by prudent long-term investing. Now, one last comment on risk versus return. Psst, here's one of Payano's secret tips. Avoid large losses. So, I did this a long time ago when the NASDAQ increased 85% in 1 year. And people would say, well, shouldn't I invest in the NASDAQ? I said, I don't think so. You had $100 and you saw investment A do 85%. Wow! And investment B did 10%. Boo. So you put your money in investment A, right? Of course you do. And next year, $185. Woo, woo, woo. $110. But then the next year, because of the volatility inherent in anything that goes up 85% in 1 year, you find that it falls 50%, where the boring investment went up 9%. So how'd you do? Oops. Wait a minute. I should have still be up 30%, right? I mean, I went up 85%, down 50%. Then no, it doesn't work that way. The numbers going down are a whole lot harder than the numbers going up. So by dropping 50%, we now are below what we originally put in, whereas the boring investment has done pretty darn well. And so this is the kind of scams that people come after you. Look, my options did 100%, 85% today. Tomorrow they might do minus 100%, which means they become zero. And that's what happens in the world of options. So stay away from them. So you see that? We're going to concentrate on these types of investments. Boring in the investment world, boring is good. But that doesn't mean we'll also look at companies that could really explode on the upside with the realization that, this is money that we could afford to lose because it could lose 50%, 80%, 90%, 100%. Once it loses 100%, we can't go any lower. Thanks for that. Now, before we embark on the process of identifying and familiarizing ourselves with the longer-term, higher-yielding instruments, let us learn how and where to park our money using short-term investments. And that's the subject of our last presentation. But wait a second, one more time. The greater the variance and standard deviation of the average annual returns of an investment, the greater the risk, the more volatile. The lesser the risk, the less volatile. There is no correlation. This is a fancy word for no relationship. Or standard what? I always hated statistics. The greater the variance and standard deviation of the average annual returns of the investment, the greater the risk. Now look, folks, don't you dare get this one wrong on the exam. Do you understand? It's bad for my self-esteem. How could they get that one wrong? We went over it over and over and over again. So do this presentation over again. I know some of it was maybe a little, I don't really understand that standard deviation part. But remember, we don't do the calculations. We just look up the numbers and we realize that if we want high returns, we're going to get volatility, which is our euphemism for I lost a lot of money. It was very volatile. But I'm in it for the long term, and I'm going to stick through thick and thin. Cool? I sure hope you're getting an education, dear students, because you are now rising investment gurus. You are going to help your friends and family and coworkers, and they are counting on you. You can't let them down. So in our last presentation for Chapter 1, we're going to go through very boring investments, short-term investments, which are meant to be boring, a place to park our money. We're going to sleep well with that money in the bank, in the CD, in the savings account, in treasury bills, or money market accounts. Cool. Thank you so much, as always, for being in our class. We are, all of us at Southwestern, happy, grateful, honored, and privileged that you are here with us.